Welcome to episode 17 of the Cashflow Connections podcast. The topic for today is the rules to remember of CRE investing. We're going to talk about a significant amount of topics today. We're going to start off by talking about the crowdfunding syndication space and how things have really changed over the last several years. We're also going to get into, is it possible to be introduced to someone online and be able to trust them and leverage their time, energy, track record, and expertise with your capital? Or is this a recipe for disaster? Is it just simply too early to kind of pursue things like that? We're also going to talk about a diverse group of asset classes within real estate. So we're going to talk about senior housing, student housing, and mobile home parks, all of which our guest is a big fan of, particularly senior housing. We're also going to get into the major due diligence items that are the first things that you should be looking at when investing in an opportunity or considering investing in an opportunity, including market selection, which our guest kind of goes into the details of what he thinks the major opportunities are in terms of market selection, and a vast array of other topics that you need to be very knowledgeable about when investing in real estate. So without further ado, let's get straight to the interview. How's it going, everyone? Today, our guest is Ross Reagan, who is the managing director of Alpha Investments. Ross has nearly 10 years of private equity experience and has participated in over $250 million in real estate investment transactions. He has a background in sales, management, acquisitions, and dispositions. Prior to Alpha Investing, Ross worked as a principal consultant to top-tier private equity groups, including Blackstone, BlackRock, and Camus. He is a licensed California real estate broker, Ironman triathlete, real estate entrepreneur, and investor. Ross is the managing securities principal for Alpha Investing, holding both the Series 7 and the Series 66 licenses. So, Ross, thanks a lot for coming on the program. Really excited for this conversation.
Hey, thank you very much, Hunter. Pleased to join you today.
So let's talk about Alpha first. What are you doing over there, and what took place in the marketplace that created a need for this company?
Yeah, so Alpha Investing, we are a private capital network. Essentially, we provide access to our investor group to institutional quality and vetted commercial real estate deals. So essentially, we kind of have three value props to our investors. We reduce the minimums on a lot of these investments. A lot of them, they could be as much as $1 million. Number two, we provide vetting and diligence for a lot of these deals that, a lot of our investor groups, they might be doctors or CPAs, or, they might even be in the real estate industry, but they might not be an expert in that asset class. So we can kind of help in the diligence process there. And then the third one, of course, is access. We provide our group of investors, our private group of investors, access to an asset class that, as it's been pretty closed off to, I would say, 99% of the population for one reason or the other. The main one being, the rules and regulations.
Totally. Got it. So there has been a tremendous amount of increase in attention to the space. Obviously, the Jobs Act, which took place in 2012, kind of allowed for public solicitation, though that really hasn't started to sink in until recently. And then there's been this incredible intention to the typical crowdfunding platform space. Now, there's a lot of these companies out there, but generally speaking, what are your thoughts on this space and the attention that it's gotten recently?
I think it's great. Our model is definitely different, but I think crowdfunding, it's definitely made capital a lot easier to find for sponsors, and it's obviously a lot cheaper as well. Previously, when sponsors, they'd be going out to, their friends and family, but anything above the friends and family money, they'd have to either go towards institutions or, a broker-dealer route, which can be, there's a lot of red tape. It can be a kind of a much more difficult process, and it can be much more expensive. So really what crowdfunding has done in the past 5 years is it's really freed up a lot of these operators and sponsors' time to where, now you can invest. Myself, I put my investor hat on really every decision I make. As an investor, if I know the sponsor operator has access to cheaper capital, that means their time is now freed up for them to work on the deal, work on the investment, work on the performance of the asset, rather than them running around country club to country club, drinking whiskey, playing golf, and raising money.
Right. And also part of that too is dealing with investor communication. A big piece of it, some people don't think about. If there's a company out there that's really good at finding office complexes in the Southeast, that skill set is very different than dealing with 35 accredited investors and all of their questions. Like it isn't necessarily the case that if you can find great office deals that you're really great at communicating. And so companies like Alpha are really helping bridge that gap to provide communication as well as vetting, as well as access, like you mentioned. So before we kind of go on into the more general stuff, given the fact that this space has gotten more and more competitive, how do you set yourself apart from some of those some of those competitors? There's competitors out there that are VC backed. They've got millions or tens of millions of dollars of budgets. What are some of the things that you do to kind of set yourself apart?
That's a great question. We really just have a different model. I mean, we're kind of the old school syndication model where we take, a lot of the work that you just mentioned that sponsors are doing, the investor management, the quarterly reporting, fielding investor calls, and really the bulk of it is actually the raising of the capital. We take that off of the plate for the sponsors. But the way, we use tech to really streamline and make our processes more efficient, but we don't use tech really to generally solicit. By generally solicit, I mean, we don't have, a website where you can just go up and really just see, anyone can see any of our deals. The reason for that is, early on when we were starting this company, a lot of the sponsors, they really didn't want their deals to just be public. With 506B and now 506C, legally with 506C deals, I mean, you could put up a deal on a billboard or up on Facebook. The sponsors we work with, these are kind of the more old school guys. They're very institutional. They're private and, they've worked 10, 20, 30 years on their business. And they didn't like the feeling of having their deals exposed to really anybody and everyone. So that's why we really felt, we'd like to keep this group small. We'd like to keep very strategic capital partners and strategic operators to where we could truly partner with them and build a relationship kind of based on trust, track record, and credibility to then, we want to be doing their deals for the next 10, 20, 30 years.
That's a really great answer to that question. I'm really glad we got into that because the track record, the relationship, at the end of the day, investors that are new to this space, you look at a deal online or anywhere, and you're looking at the documents and you're looking at the pro forma. If you're more sophisticated, this is not what's going to make or break the investment at all. And companies like Alpha and people like Ross will testify to this. It's not about the documents. It's not about the presentation. It's not about the ROI at the bottom of the pro forma. It's about the people you are making a bet on. And this cannot be stressed enough. And that's exactly what you're kind of alluding to. You're bringing the relationship, which is the most important part of all of this. So definitely glad you mentioned that.
Yeah, I mean, you're exactly right there. I mean, we understand that, by access, we don't want to just bring access, to our investors of, here's a deal, here it's sitting in your email. We understand that every investor, they're not going to have the opportunity to go meet these sponsors and operators face-to-face numerous times, have lunch with them, dig through their models over the course of, 6 months, a year, 2 years. We understand that we can't, directly translate that relationship to the end investor, but we want to help as much as we can by at least relaying that, that credibility, that trust there. So that's why we really feel the need on both sides of the, really the equation, the sponsor operator, and really more importantly, the investor, that we have that personal touch, that we have that relationship with our investors, because ultimately, we just didn't really think in the long run that it was as viable of a business model to really rely and really make the bet that people are going to be investing with no human interaction. I mean, right. I found it, as an investor prior to starting this company, I was very, very hesitant to cut even small checks for these deals just because, I don't know what's going on the other side. I mean, I could see it in my email, but without knowing that person and trusting them to some extent, it makes it very difficult.
Cool. So let's talk about some of the deals that you're looking at right now in terms of what you're most bullish on. What is the kind of investment that you wake up, you get an email from somebody, say, wow, I've got to answer this email right now. I got to jump on this. I got to reserve a block. What is something that you're just super excited to see in terms of deal flow?
I mean, if you would talk to me 5 or 10 years ago, that's super exciting, kind of jumping out of bed would have been really something with, high projections and high numbers. In the past 5 years, as I've dug through, hundreds, if not thousands of deals, I'm sort of immune to the projected numbers, and I really go straight for the market research, the comps and the story. So, some of the asset classes that, I'm bullish on right now, I still like anything with a residential component. We've done a lot of multifamily. We've done primarily senior housing, which I really like. Even getting into student housing and mobile home parks. I mean, things that, people obviously they're always going to need a place to live. Some of these asset classes, they have a lot of defensibility, even in a down market. I mean, the market cycles will go up and down. But some of these asset classes, even within residential, can be less volatile due to some of these macro concerns.
Yeah, that's a good point. So you mentioned senior housing. What are some of the reasons that you're drawn to that asset class in particular?
Senior housing, that was kind of a no-brainer one for us, and that's kind of where we cut our teeth with investing. We met, originally, a great senior housing sponsor out here who really taught us really everything we know about senior housing. I mean, the demographics are obviously very attractive. There's over 10,000 people are turning 65 every day. Baby boomers are about to hit that that prime age where they're going to be needing senior housing. Also, it's really just a fragmented space. I mean, obviously, apartment complexes, they've been around for 200 years, but senior housing, in the kind of the definition in which we look at senior housing, has really only been around 20, 30 years. The complexes are typically a lot smaller, so you're seeing a lot less institutional and Wall Street money chasing these deals, which leaves a larger void for some of these mid-market operators who are institutional quality, but they're just they can go take down the $5 to $20 million deal. So we see a lot of kind of market inefficiencies with some mom and pop owners, and we really just see it's the asset class is in its infancy right now. So we see it poised for dramatic growth over the next 10, 15 years.
Got it. So when conducting due diligence on not only just senior housing, but in just investments in general, I know it may differ depending on the asset class, but what are some of the metrics you look for that are going to help you determine the profitability of the asset class? What are the first things? Is it the property size, number of tenants, metropolitan area? What are like your main due diligence items you want to check off the list first?
That's a great question. I mean, again, early on, I would compile checklists and forms and documents to try to guide me through the process. Now obviously I use those as kind of a base, but every deal is different, every sponsor is different. The information you're going to upfront get will be different. I would say that the things I'm going to initially look at, obviously, what's the asset class, what market is it in, and within that market, jobs. That's one of the biggest things we look at. Without jobs, it's just very, very tough for me to make an investment without having that market or even sub-market have substantial job growth. Second thing that I'm really looking at, especially being that we're in kind of the, you could say we're in somewhat of the end of the market cycle. I look at, debt service coverage ratio. So, this is kind of what I look at as kind of a snapshot, easy indicator for how leveraged is this thing? How risky is this? What is the likelihood that this thing will absolutely make sure to be able to pay its debt service so equity holders are protected? I mean, ultimately, our number one priority is preservation of capital. We never want to see a scenario where our investors are even getting close to losing, their principal. So debt service coverage ratio, job growth in the area, and really the submarket. Those are the three initial things I'm looking at.
Okay, yeah. I mean, we could do a whole podcast on each one of those, but I definitely want to ask a couple questions because you touched on a couple things. First of all, in terms of market, which markets are you seeing the most opportunity in right now?
We're looking a lot at secondary and tertiary markets. Places like Sacramento, Charlotte, Denver, even getting into Houston area. We're seeing that the primary markets. I mean, you really can't get any yield there. We're staying away from anywhere where there's a lot of kind of flight capital coming in. I mean, if you go and look at New York, San Francisco, Los Angeles, I mean the cap rates are they could be in the 1s, 2s, 3s. Only because they're so low, because there's very little risk that there's going to be a huge crash in one of these major markets to where people just for whatever reason do not want to live there anymore. But the dollars that we're competing with there are flight capital, which is a lot of Chinese money and international money that all they really need to do is beat a very low percentage, and they just need to kind of park money. So we're bullish on these secondary cities. Another reason is there's this huge trend towards urbanization right now. Millennials especially, they're not getting married in their early mid 20s anymore. They're not having families until a little bit later. So typically, you'd be a 24-year-old family, you'd have a kid, you'd go move out to the suburbs. Now, if you're 28, you're single, don't have a kid, you're not going to go move out to the suburbs and buy that, house with a picket fence. So you want to go into the city, that's still where the jobs are. Again, everything really kind of ties into jobs. So they go into the city, LA, New York, San Francisco, priced out. I mean, rents are absolutely crazy. I just came from San Francisco a few years ago, moved to Manhattan Beach, and I feel like my rent was in half. But
which is crazy. Anytime you find yourself saying, "Yeah, I'm going to save so much money if I move to Manhattan Beach," you should just move to Manhattan Beach.
I'm on the beach in front of the water. It's absolutely insane. But a lot of these cities, they're drawing, they're drawing employers, and they're obviously drawing a lot of, growth in the area.
Got it. You also mentioned debt service coverage ratio. What are some of the, let's say year one debt service coverage ratio? What are you looking for in terms of that number?
Again, 5 years ago, it would have been, a 1.25. Now I like to see, 1.5. Kind of on the low end.
Right.
Trickling up towards, we see a lot of deals that, it'll be 1.7, 1.8, 1.9, which, it makes me feel a lot more comfortable.
Yeah. And there's some asset classes, people may hear that and think that would result in really low returns. There's certain asset classes, particularly mobile home parks, where you can get 2x, sometimes 3x debt service coverage ratio. And I know that you have a background investing in mobile home parks. It's crazy because, not only that, you've got a very low default rate. Mobile home parks have the lowest default rate in all commercial real estate assets. And people always think that, okay, I hear people frequently make comments that when there are recessions, the people that get hurt most are the lower incomes, which actually there's definitely some truth to that, especially since their incomes are deteriorating or there's more people moving into those low incomes. But at the end of the day, when you're at mobile home parks or C or B class apartments, there's really not that many options at that point, especially mobile home parks. So if you want a place to live, you're going to pay off your rent, and that leads to some really interesting investment opportunities, given the sticky tenant base of those asset classes.
Yeah, I 100% agree. I mean, again, mobile home parks are one of those asset classes that, it just hasn't really drawn the eye from, quote unquote, Wall Street money. I think there's, one big fund going around. But it's not that sexy asset class. It's not that, hotel deal. It's not that, condo development on Ocean Drive in Santa Monica. So, for the longest time, people have kind of just thrown it under the radar, swept it under the rug as, mobile home parks. I don't want to be getting into that. It's too much exposure. Look at the demographic. But really, again, getting back to the story, you get the right operator, the right kind of subset of mobile home parks, and your yields are doubling and tripling with, I would say, even a smaller risk profile. So I totally agree with you on that.
Cool. Other than the debt service coverage ratio, what are some of the systems or structures you implement to protect your investors from a deal structure perspective or otherwise?
Yeah, so that's a big one. One thing we always do stress tests and sensitivity analysis and, look at seasonability, and we say, okay, well, we can always look at the T3, T6, T12 of the property. This is what happened in the past 12 months. Of course, most of the stuff that we're looking to acquire and invest in, we're hoping that NOI is going to increase. But again, just to be overly conservative, to be overly cautious, as these are different market cycles. You never really know what's going to happen. We put our stuff through a stress test. So we basically say, okay, here's an asset, an apartment building we're purchasing in Seattle or right outside Seattle in Port Orchard. And with this, we'll take a look and say, okay, in 2009, in one of the the largest recession since in 70 years, we'll take those numbers and see how it performed in that type of market, and then we'll put those into the deal now and say, okay, what is the debt service? What are the cash flows to investors? What's the total IRR? What is the ability to really hold this thing through and stabilize it, and make it to the other side? So that's one thing, we put every single deal through. And if it's even close to saying, this thing might not make it, might default, or the bank might have to take it back, or, cash flow, or, investors could potentially have a capital call, we'll move on. I mean, there are enough good deals out there.
Yeah, that's a really good point. What are your thoughts on some of these cities that have experienced a ton of growth since the 2009 time that you're talking about? So, for example, you mentioned Denver. I was in Denver recently, and I recently read that 15,000 people are moving to Denver each month. They're anticipating at least 100,000 people are going to move there in 2017. Are you interested in these markets given this run up that they've had, and what are your thoughts on that?
Yeah, I am. I mean, Denver, it's very similar to also some of the hot spots that we look at, Austin, Texas, and Nashville, to where over the past, say, 5 years, I mean, they've had, population growth of 15%, and they've also had, rent increase by, say, 30, 40%. Cap rates have dropped, 250 bips.
Right.
Enormous amounts of growth. Where, initially I want to kind of look at this and say, okay, well, kind of the technical analysis of this, they're at the peak right now. Like, wow, why would I want to buy in at the peak? But really, I mean, then I take a step back and kind of take my ego out of it. There's still a lot of room for growth, I think, in all three of those cities. And then also adding Sacramento to there. So Sacramento, Austin, Nashville, and Denver. As long as I look at a pro forma and I don't see that they're modeling out forward-looking growth the same as it was the past 5 years, I'm okay with it, which is one thing that some, operators will try to do. They'll say, hey, look, it's grown 30% in the past 3 years. We're going to model it out only, maybe 7 or 8% per year. And look how conservative we are, which, I think you can't directly just look back and say, we had this huge boom, the boom's going to keep going. So I like it as a stabilized market. Again, to be conservative, I'll look at it as, these markets are not going to grow anymore. But then I'll look at it from that point of assumptions to make sure that I am conservative.
Got it. All right. We've talked about a couple of the investments and the markets that you really like. What are some of the investments that you are really bearish on that you want to stay away from right now?
That's tough. We are in, a very tricky, part of the market cycle, which is why, we really rely on strong relationships with, only the top operators. I think in any market, in any environment, in any asset class, whether it be stocks, alternatives, real estate, there are going to be opportunities. They're just going to be definitely a lot fewer than there were. One thing that we don't typically look at is retail. Not to say that there aren't great deals in retail right now, just that there's a lot of, again, uncertainty with retail. I mean, if I were to look at something, I'd want to see, again, a lot of defensibility with, maybe anchored by a 99-cent store or something that's going to help out in a downturn. Some of these asset classes that have, a very large, office tenant that's 60, 70% of the building, if that's not really a high credit tenant, if there's any opportunity for them, whether it be retail or that office tenant to, that now turns into a vacancy, you're really in a tight spot. So I would say things we don't look at are, any asset class that could potentially, with one tenant move out, really damage, the performance.
Okay. And so a great segue to that is number of tenants is obviously critical to your perspective on this strategy, because if you have a single tenant property and one tenant moves out, then yeah, you're going to have a problem, especially with the debt coverage ratio, which you mentioned earlier. In fact, for the listeners, that's something to keep in mind. When you're talking about sensitivity analysis, number of tenants is critical. So I know some people that look at retail and they usually look for a minimum of 13 tenants. The number of tenants is an important part of your sensitivity analysis, especially when you're looking at a debt service coverage ratio, because you could have a really solid debt service coverage ratio, but if there's 3 tenants and one is kind of borderline on continuing to release, you can have a really serious problem. So number of tenants is definitely one way of kind of mitigating yourself. What about the class of properties? What class of property do you think is opportune, or are there any classes that you're just completely staying away from?
Again, not to say that I would completely stay away from, but I would prefer stuff in the class B plus, down to C plus range, only for kind of some of the reasons we defined before.
Right.
With the Class A stuff in a downturn, that's always what we're looking for. We're saying, instead of being overly optimistic, which I would love to wake up but when I'm to some extent looking to make investments for some of our investors and some of our partners, I need to be as skeptical and as pessimistic as possible. So it's tough to look at some of the Class A stuff and say, hey, this is not going to get hit during a downturn. Whereas, just like you outlined, mobile home parks, in a down market, those could actually, outperform the regular market.
Right. So one of the benefits of conducting this podcast is I get to talk to a lot of people with a lot of different perspectives, all of which are being really successful in real estate. And this is something that comes up a lot, the discussion of A class versus B class versus C class. So what would you say to someone making the argument that A-class properties are the most safe because these are the properties usually occupied people who have higher education, they maybe have extra family money, so if things go really south, they're the ones that are going to be able to make things work, as opposed to lower income families who are going to be really hit during recessions? What are your thoughts on that perspective?
Yeah, that's a great point. Again, it depends on some market. It depends on asset class. But just on a macro level, Class A properties, there's less of a pool to draw from. Obviously, there's less people that can afford a Class A property than Class B and C. So right there, you're kind of limiting supply. Not to say that in that certain submarket, there still might be that extra demand. To your point, with Class A properties, if it still makes sense and the property can still perform by just dropping the rent, say 5 to 10%, you're not going to take that 20% occupancy kind of hit. But really, one of the reasons, I need to look at the employment. If there's a down market, say the stock market corrects 5 to 10 points, you're probably fine. That the person in the Class A, maybe their retirement plan got hit, but they'll ride it through. But if they have a family or there's a couple, one of them loses their job, which again, circling back to employment drivers in that submarket, in that market, right. Someone loses their job, it's much more difficult to stay in that apartment. And the first thing that they're going to do, especially being that they're generally more educated, is they're going to say, hey, okay, am I going to, the first thing they're going to cut is say, I don't need this really fancy pool. I don't need this fancy spa. My wife just got, we have huge medical bills now. We need to downsize. And again, it's not like they're downsizing from a Class A, into, the mobile home park. The first thing they'll do is they'll go from a Class A maybe down to a B, B plus. And even then with apartments, it's so easy to move in and out. There's not really a huge barrier for them to stay. So they can say, hey, in 30 days, I could be paying, $800 less a month. That's really going to help me out.
Yeah, that's a really good point. And I appreciate that perspective. You mentioned jobs a couple times. What are some of the websites, or how do you get this information when it comes to jobs? Where are you doing the due diligence to get accurate employment data?
It's tough. We look at it, we're relying on a lot of these third-party reports, Axiom metrics, Reese reports. They can be quite costly. But again, we think that it's definitely worth it just because we think that's so important. So it's not as easy as just going on a government census website and kind of figuring it out. This stuff really needs to be prepared by third-party professionals.
Right, and I'll go ahead and link to those two in the show notes page. They are expensive. They're for basically people that are operating companies. However, if you have if you're looking at a deal and you're dealing with a sponsor, they should have access to these companies because they need accurate information in order to correctly anticipate employment growth or a myriad of other stuff. So I'll go ahead and link to those, and definitely ask your sponsors, to the investors listening at home, ask your sponsors for this data to verify the claims they're making in terms of employment. You mentioned retail, and I think a lot of this issue, like a lot of the issue you have with it, sounds like, particularly with the internet, is coming on, it's putting a threat in that asset class. Mm-hmm. Are there any, obviously the tenant base is really what the important part is. You really want to stay away from people that are looking at retail that have tenants that are full of, they're making merchandise sales that can easily be purchased on Amazon. If you look at the recent big box, everything is struggling. Everything is struggling because Amazon is eating everything. So the tenant selection is a really important piece. I'm currently investing in retail, but the tenant base is very, very specific. And that's like the major concern in that asset class. And that's just, of course, my perspective. Do you want to add to that at all?
Yeah. I mean, I totally agree with you. It's very kind of deal specific. I mean, you mentioned actually earlier, you like to see, or, one of your investors likes to see 13 tenants in there, where, I totally agree that you're obviously more exposed with if you have 1, 2, 3 tenants with one of them leaving. But I think even, equally as important as, the quantity of tenants is the quality of tenants. So the tenant credit rating is extremely important. For example, we've looked at a deal where, Microsoft was 70% of the building, had about 400,000 square feet up near Seattle, where Microsoft, that's a tenant that, I'm very confident is going to stay, that they're, a credit A tenant. That's something where we can look at, and I'd feel a lot more comfortable with a large tenant like that. Or, for example, or another example, told me that we had a development. It's a 30-year triple net lease with Starbucks or McDonald's. I'm going to sleep a lot easier than if it's a 30-year or 10-year lease with a nail salon and some small bookstore or whatever else it may be. So I think the credit rating of the tenant is extremely important for me. And it's, again, there are a lot of asset classes, and retail, it's tough to find the good deals, just like some of the other ones right now. But it's very deal specific, I find.
Yeah, great point. Here's a question. It's kind of some closing questions that I think kind of get a good perspective on your big picture perspective. What do you think will be the number one determining factor for who will succeed and fail in real estate over the next 5 to 10 years?
I think it's going to be experience and track record, and kind of what comes with that is being cautious. I think a lot of these guys who've been in the business for 10, 20, 30 years, they've seen the down cycles. They've seen, really every cycle that there is to be had, where they're not going to jump at the one sexy deal and they're going to miss something. I think people who are, too eager to make deals happen, we see a lot of guys, and I don't want to talk probably on brokers, but, brokers are, definitely deal guys. I mean, I was a broker myself, love doing deals. And guys who are just stretching to put deals together, really wanting to make it happen, rather than sitting back and saying, is this the best deal for myself? Can I operate it? Can I manage it? What's going to happen if this goes wrong? You pull all these levers of Armageddon scenarios. And, if you're not patient and cautious, you're going to miss something, and, that could completely blow up.
Yeah, that's a great answer. And you've touched on some of this already, but how are you kind of implementing that into your business to make sure that you're one of the companies that succeed in the next decade or so?
Yeah, I mean, again, we're very cautious with our investing. We look for, high risk adjusted returns, but we're still very cautious. We're not going to do a deal just to do a deal. We'd rather be patient and picky and wait for the right deal for us and our investors. I mean, one of the big things that we like is, this company was kind of started on, myself and my partner, initially investing on our own. We were looking to make some investments, looking for top tier sponsors, and we were investing. And then from there, it really snowballed out. So, we look at this entire industry and every decision we make with our company as, is this best for our investors? Because we have our investor hat on first. We are investors in our deals on the same terms as our investors. So it's of course to our benefit to make sure that our investors are protected. But again, one of the things as far as kind of passive investors and syndicators like us, even a lot of the private equity guys, is we want to align ourselves with top operators. I think it's best, when you're looking to invest, make sure that the people around you, they need to know what they're doing, and you feel comfortable with the decisions that they're going to make, and that the decisions that they're going to make will be in your best interest. A lot of times they're not going to intentionally try to give money to investors, but if you can align the incentives, then when they make money, you make money. What we do not like to see, and what we don't want to be a part of, is a lot of deals with operators to where if the property is not hitting their numbers, then they're still getting feed out, and it doesn't matter to them. They could lose attention and go off on a new property and say, yeah, this one will we'll kind of just dump this one, slide it under the rug, but they still get paid out. So we want to see structures and things like, waterfall tiers to where, they basically, of course, they can, run the business and operate, but they don't really get paid the bulk of the money until, it really hits optimal performance, whether that's a high IRR hurdle, a preferred return. There's a few different things you can do to structure these deals to make sure that, you are protected for the long run.
Awesome. You touched a lot of stuff there. I think the most important key takeaway from that is the incentive alignment. If you are in a deal in which your incentives are pretty close to perfectly aligned with everyone involved in the deal, that's in the decision-making process, their behavior is going to implement that alignment. It's going to execute on that alignment. And if it's not, they won't. At the end of the day, it doesn't matter how ethical the people think they are going to act along incentives. So it's critical that before you invest, you make sure that you understand how the incentives are aligned. And if they're not aligned correctly, you have to pass. And sometimes it hurts. Sometimes it hurts because you can take a great deal and destroy it by improper incentive alignment. And I'm sure that you guys have done that many, many times.
Yeah, I mean, that's absolutely right. I mean, there's a lot of deals that fall out on the 11th hour. So people really need to be prepared for anything to happen up until closing. That's why you need to have, the right people with your best interests in your corner to make sure that all through the escrow process, throughout the investment process, if anything does happen that, could be an issue down the line, I mean, they're comfortable and everyone's comfortable, pulling the plug if just something doesn't feel right.
Awesome. Well, Ross, thanks again. We got a lot of stuff done, a lot of great general information as well as some specifics. I think the listeners are really going to appreciate that. So thanks again for coming on.
Great. Hey, thank you very much for having me.
For all the listeners out there, thank you very much for taking the time to listen to this episode. I hope you enjoyed it as much as I did. If you do have a moment, it would be greatly appreciated if you would leave us a review in the podcast app. I know I've asked before, but I can't ask enough because it really does make a big difference in terms of the visibility of the show, as well as our ability to get really quality guests. So just take a moment, go to the podcast app, leave us a positive review or an honest review. We're not soliciting fake reviews, but an honest review. Just anything you've learned about the show, or if it's helped you in any way, or if you're just getting started in real estate and the show has kind of helped you with your education, it would be greatly appreciated. Thanks a lot.